All right, hello and welcome everyone. Doug with the LincolnList.com. Today's video lesson, we're going to be talking about the best trading indicators to use for day trading. And our focus is going to be on the volume weighted average price, also known as VWAP. Now, is this the holy grail, bestest of all time indicator, guaranteed to take you from rags to riches starting tomorrow? The answer is no. It's just an indicator, like all indicators, based on a series of mathematical equations. And like all indicators, they lack one very important factor, and that is measuring human emotion. So until something like human emotion can be measured, you will never have perfection. But it is a very valuable tool. And not only are we going to talk about what it is, we're going to talk about how to use it. I'm going to give you a couple of trade ideas and trade setups on how you actually use this thing. Now, if you've followed any of my videos in the past, I've always said, and I will continue to say, that the very best indicator that you can use, if you just had one that you had to rely on, that you could use, bar none, hands down, the best will always be support and resistance. The value of knowing where buyers and sellers meet on a chart, where people have interest in owning a stock, or where they think a stock is overbought, or understanding important price levels is paramount to you being successful. Now, however, I've already done a video on that. It has live trading examples. So if you're kind of new to trading or you want to learn a little bit more about that, I'm going to flash somewhere up here on the screen the link to that. Just take a look at it. As I said, it's got live trade examples. It shows you how the support resistance works in real time and how important levels are and pricing is to stocks. So if you want to, go ahead and check it out. So let's get back to talking about this VWAP here. So first, what you're looking at, so we're all on the same page, is this is only based on intraday day trading. This is not looking at a stock's fundamental value. This is not judging a stock based on its fundamental value or where you think it may be trading in a year, or what your personal beliefs about the company, the product, etc. As a day trader, a market technician, as most of us are, it's all about timing. And with our indicators and our setups, we're trying to narrow down our timing the best that we possibly can so we can maximize our size and maximize our opportunity. And what helps with that often is this VWAP. Now, I'll honestly say that because I don't read a lot of books, I'm not the best person to give you the verbatim greatest definitions on what the VWAP is. If you really want to know exactly what it is verbatim, then Google it or go to Investopedia. The way it is, the volume weighted average price is basically weighing the volume against the price of the stock. A little bit different than what you have with a moving average. But here's how I want to translate this to you in layman's terms. Here's how I want you to think of this. Okay, just two ways I want you to think of what this thing is. Consider it like the stock's price long lost lover. Okay, that means that they are separated, but they don't want to be separated for long because they're going to have separation anxiety. Okay, so meaning that at some point during the course of the day, you may find that the VWAP and the price of the stock are separated, but at some point during the day, those two lovers shall reunite in the future. The other thing is to consider that's what the stock should, I'm going to use air quotes, should be trading at. And when I say should be, that's at the current time, at that moment in time. That doesn't mean that it's worth X amount of dollars, like we said, fundamental analysis, or a bias to it. That's just where the stock should be trading. So what we're going to do is we're going to look at Tesla today. It's a very great example of how the VWAP works. And I'm going to give you a few examples of how to make trades, because this is what's important. And this is why we use indicators, is because we have other things that we have ideas with biases and setups. And we want to look to these indicators because they help us with things like entries and exits. Now, I'll be up front, I hardly ever use an indicator for an entry price. I almost always use them for exits, but that's because I'm a counter trend trader. If you don't know what that is, you're going to find out in just a second. But I hardly ever use them. Now, that doesn't mean that they can't be used for it, because you're going to see it's a very valuable tool to use. So let's just kind of go back and look at Tesla. We're going to start with the story that it's already ripping and it's going vertical here during the day. You got this big, huge move, and there it is. So let's say you just kind of turn on your computer. This thing's floating into space, and you're trying to figure out what you should do. Should you buy? Should you sell? What's going to be the next level? How's this VWAP thing work? Okay. Now, if you remember what I said earlier, I said that they will reunite somewhere in the future. And one way is that you can just quickly look with your eyes to judge on a short-term or even a longer-term level is when a stock becomes overbought is the separation between the VWAP and the current price. So you look at this thing as it's starting to stretch. They start out, they're pretty much like two lovers holding hands, like kissing in the morning before they go to work. And then Tesla drives off to work and VWAP, she goes over here. She's down over here at 316. So at one point, there's a separation of about $4 in price. Now that's pretty far even for Tesla standards. So anytime that you just, and I'm not saying it's going to work this way in every scenario, but in most situations when you look at deep separation like that, where it's spread by more than $1 to $2 away from the VWAP, in most cases you're looking at a short-term overbought. Now when I say short-term overbought, that doesn't mean that by the end of the day that Tesla wouldn't be at 330. It wouldn't be higher than where it is. It's just on this time frame, in this time period, this is a little too much euphoria, and it's probably going to, to pull back a little bit, to sell off a little bit. So two things will happen with this VWAP. And one will be either the stock will stay in a range up here. So let's just kind of look at here, 320s to 319s. Either the stock will stay where it's at or relatively close to where it's at and let the VWAP catch up to the stock, or what the stock will do is come back to the VWAP. That's one of the two scenarios that are going to happen, because at some point during the day, most likely, they're going to reconnect. Remember, they're lovers, they're going to reconnect. Now, how this helps you, let's say you missed this breakout Tesla. You realize range-wise, this is up a lot. You decide you want to short this stock, and you have a very good reason to short. It's extremely high. It has good rejection here. This is a good technical setup for something like that. We don't have time to go into the exact technical setup. But let's say that you want to short this stock. You want to use that counter trend trading. You're looking for reversals. And this will help you understand also if you're going to do dip buying too, stocks that flush, or you're in a situation where you own maybe a longer term holding or a stock and it's been down a lot. You wonder, when's my stock going to turn around? Where may my stock go? Everybody kind of wants to know that answer. So if you short this, when I normally do this on a counter trend trading, what I'm looking for is I use my indicators for exiting. So what I'm thinking of is if I short in the 319 area and I put a stop at high a day up here at 320, I'm risking $1 of my money to make this trade. What would be my target? And if I'm looking to maximize my target, I want at least 2, 3, 4 to 1. I don't want to just do a 1 to 1. I'm not shorting it at 319 to take 318 if I can help it. So when I do that, first thing I look at is the VWAP. The VWAP being at 316 and I make the short, I realize that that's most likely the next scenario that comes to play here. If the stock pulls back, that's where it will trade. Now, if you've seen some of the past videos, what I should clear up and where I'm going with this, not to be talking too fast or confusing people, is always remember stocks normally don't trade randomly. They trade from one level to the next. And again, I don't have time to go into this, but I'm sure if you look in the chart, 320 means something. But when we're talking about they go from one level to the next level, if this stock starts to break down on a short-term basis, that next level is 316, somewhere in that area. Now, it doesn't have to be perfect, but that's the trade we're looking at. So we're looking at a possibility of a $3 to $4 gain versus a $1 loss. That's a great risk to reward. So to kind of speed this through, you see that Tesla starts to fade, and it works its way down there, and eventually it hits that VWAP right there at 316. And then you'll see that it actually stops. Now, what I want to do is kind of reverse here, and I want to give you a couple of scenarios because hindsight's 20/20. Okay, I want to put you in a different position, not just based on a short call. Let's say you are long this stock. Okay, because eventually what happens here is you see the stock holds its VWAP and then bounces. It trades right back into it and then it bounces. So let's see how we can actually use that. Let's say you're not a short seller. You don't want to short this. You're not concerned about this being your target. You made a mistake. You chased it up here and you bought it. So as soon as you buy the stock, it starts dumping on you. We've all been in that situation, right? So now the stock is dumping on you and you're like, damn, what do I do? Where's the stock going to go? Is it going to go back to red? Am I going to lose all my money? You know, you start to panic. Now, the reason you panic is because you don't have certain levels in your mind. You haven't thought that out. But let's use the VWAP. Let's go to that VWAP. So if you're sitting here and you bought it and it's starting to drift on you, you say most likely this stock I'm going to get into is going to probably, it has a high probability of trading down to 316. That's probably what's going to happen, you know. Now that's not a guarantee. Maybe, you know, it tried to bounce. You can see on each one of these candles, it tried to make a bounce, but ultimately it gave that up. Now the way I look at it is when they come down like this and they start to make bounces, you gotta be weary of that bounce, because that bounce is happening at a level that's not really as important. So if it decided, let's say randomly, it wanted to bounce at 318 and started going back up again, you have to ask yourself, what's the significance of 318? Where does 318 come important when 316 is the VWAP? Why is 318? Why is that the bounce point? See, a lot of traders never think of that, but why would that be the bounce point? Now, even if it bounces and you decide to take a trade, you have to kind of keep one eye open, because that's not a real solid level, far less solid than this one. But let's get back to business. Let's say that you are long, you're panicking a little bit. Well, you kind of know that you should at least give the trade at this point down to VWAP. You either need to cut it or deal with the loss here, or ride it down to the VWAP and then add to the position. It'd be a great place to add to the position. That's another way to look at it. So you can either short the trade that gets too much separation from the VWAP, or if you bought the thing because you thought it was going to break out and it starts to reverse on you and you find yourself upside down, then you can use that VWAP as a gauge for either add to your position or ultimately cut your losses. But it's nice to know that if you bought at 319 and it's sinking to 318 and you're in somewhat of a panic, that you feel like, well, look, 316. You can prepare yourself for 316. Might not be the best thing to do in the world, but at least you know. And when you know, it removes a lot of the anxiety. Now let's take a look at trade number 3. When it comes down here, look what happens when it gets to the VWAP. It holds for, these are 5-minute candles. It holds for just a couple of minutes, and then it explodes right off of it. You see, look at the size of this candle. It goes from 316 to 317 and a half instantly in just like one candle. So let's look at another trade. Let's say you wanted to buy it. How nice would it be to wait for that stock to pull back into its VWAP, then buy it down there? Okay. Now, I can't give you the answer of why the thing is so important. Maybe it's an algorithmic program at large institutions that they like to use. That's something I can't answer. But you go back and you look through these charts, you will see that the stocks almost always bounce at their VWAP. When they pull back into it, they almost always bounce. Now, it might be a lame bounce. It might last for 30 seconds and then just retrace and go lower. But almost every single time you will see them attempt, or at least make an attempt to hold it and try to bounce. And see, that's what's the valuable tool, because if you're either shorting the stock, that's what you use as a target and you've got a good risk to reward. If you accidentally made a mistake and you're long or short, you know, it works the same way if you're dip buying, then you kind of know where it's going to go. And then if you are patient enough, you kind of wait for it to come back into the VWAP, and then you buy off the VWAP with a $1 stop. Now, to show you the kind of the importance is, this thing does run up here again, but look what happens later on in the day. Even though again, what happens when it gets big separation? See here, it holds, it kind of starts to break out a little bit, settles in, then it really goes vertical again. And up here, you got the same scenario playing out. You're at 322 with a 317 VWAP. So you got this amazing spread between these two. And what happens? Either the stock is going to have to stay put, let the VWAP catch up, or the stock's going to come back down into the VWAP, right? So the same scenario plays out on two separate occasions. You get a ramp up and then a retest into the VWAP. You get a ramp up and a retest into the VWAP. Now this one took a little bit different route, but the same scenario played out. So hopefully you guys kind of see how this stuff works, is that not only is the VWAP important, but stocks move in these sequences and patterns. So anytime they start separating too far, it's not a good idea. It's a tough buy, because what happens is usually this. It's going to trade back in there. And this was a bit exaggerated today, and you can see that once it broke through the VWAP, again, it breaks through it and sells off. What happens? When it eventually bounces, where does it go? It goes right back here to the VWAP. Right? So it always seems to be like a magnet, not just a lover for the stock. It's always like a magnet. And what this really kind of helps you out, regardless of what kind of trader you are, it lets you know that at some point in time during the course of that day, that you stand a very high probability of that stock working its way back to where the VWAP was. And that works for a lot of stocks. I'm going to go just down through a list. I'm just going to click on my watch list. Here you have this Bungie. You have the same thing, a big vert move in the morning, retest the VWAP. It's almost like a little miniature Tesla move. You got the vert, a pullback into VWAP, a re-rip. Where does it end up? Comes back to VWAP, sinks below, then ends up trying to retest it later on in the day. URI, here's another one. Same thing, vert in the morning, pulls back into the VWAP, goes vert again, pulls back to the VWAP, goes vert again, pulls back to the VWAP. So you guys see the rhythm right there, okay? You can pick whatever, it did the day before here, vert back to the VWAP. You can pick anything you want. Here's Twitter, vert, goes back into the VWAP, pops, goes back into the VWAP. You see how it just keeps doing that. This is how you make money. So you can take whatever approach. You saw 3 here. You go right down the line. I'm just clicking randomly on the watch list. You just look at these. They're all the same. Here's Momo, pop, it holds into the VWAP, tests it later. They always seem to come back to one another. So here, let's just kind of tie this all up. Let's tie this all up. I'm sure you can already see it. Number one, you get too much of a separation from that VWAP. It's probably a short rather than it is a long. That's something that you have to take into consideration. It's a very risky play. If you don't want to short stocks, you think that's too dangerous for you, you don't want to take advantage of that, then wait until they pull back. Look at these buy prices. You could have got Tesla down here on the VWAP at 316 and caught that pop. You could have bought it back again down here. Now, this one wouldn't have worked, but you at least had a good level. It was better than buying it up here. You had Bungie here. You could have bought that first pullback into the VWAP. You have that. Also, it helps you with targets when you're shorting, but it helps you understand as well with your longs, because it's a very difficult proposition to be buying stocks like this that have large separations from their VWAP. Look what happens about every single time you start getting some separation from this. Like I said, they're two lost lovers who have missed each other. And no matter what the stock is, every single time that you come up here and you start getting separation, this is what's going to happen. They're going to connect back together in most cases, and that's just the way it works. That's what makes it so valuable. So I kind of ranted a little bit. I got into it because when I start talking about stuff like this, I get on a roll. But look at this is just a standard VWAP setting. I don't use the upper band and lower band for some of these settings. This is just regular old settings right here, and yeah, I got 0, 0 on the deviation numbers, just a standard, nothing fancy. But again, it's just a gauge. It gives you an idea of where your stock may trade, but it puts a little bit more power in your hands, as you saw. You see the most important things, too much separation from it. You really want to buy the stock, just hold off. In the long run, it's going to pay off more often than it doesn't for you just to be patient, wait for it to pull back. If you want to make a strategy out of waiting for strong stocks to pull back into VWAP and base, then you buy them. That's a great strategy. That gives you a great process to follow. It gives you a good indicator to help you. As I said, they won't always be perfect, but it gives it to you. Now, if you're a counter trend trader like me, you trade flushes, you trade paras, you can use that for a target. You can see how they slide right on back into there, and they stand a really good chance. That helps you maximize your profits. So hopefully this thing can help you out. As always, if you need help trading, visit thelincolnlist.com. Take care.